Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the show. I'm Victor McClure.
And I'm Guy Allard. Man, I tell you, during this last week, 77 degrees, I was ready to get the boat out. Not so much anymore. What happened?
I got frozen all of a sudden.
I know.
Somebody told me, I saw this, it might have been on Facebook or whatever, about only in Texas do you have your air conditioner and your heater on the same day, and I do. I put it automatic where it heats or
goes
cold,
back and forth.
And it happens all the time. Like, turn the heater off because it was so hot, and I left it off the other night. I think it was last Thursday maybe. And all of a sudden my daughter comes through, freezing me to death. My guinea pigs are popsicles. I'm like, oh, forgot to turn it back on.
My wife's got these real pretty deep blue faded to lighter color pots where she's got 8 palms that go on one of the back terraces, overlooking the water and back. Of course, this time of year, they got to go in the garage, and I park outside. Then you got to run them back outside on a 77-degree day, right? So they can get some sun, because you can't keep them in the dark all winter. Then you got to roll them back in. All I hear is, "Guy, help me with the palms."
My brother-in-law tore his bicep on that, picking them on the big old pots.
Right.
Is that on the left wing of your house, of the mansion, of the lake mansion, or the right wing?
But I know you'd think with a 3.5-car garage you'd have more room. There is no room.
I have more junk in my garage. I don't even know what's in there. I went in the attic sometime. I found like my old Navy uniform. I was like, let me try this sucker on. It wouldn't fit over my left shoulder.
Did you try?
Apparently, I was a little heavier than I was then. That's what I remember.
Or you were just really skinny.
Like a 28-inch waist, and it's gone beyond that a little bit since then.
They had a doctor on the business show earlier this week, and he was talking about obesity and that weight causes inflammation, and it was real important. And the guy said, "Well, what is overweight?" He goes, "Well, it's a certain amount of weight per your height." He goes, "Well, what is it?" He said, "Well, for instance, if you're 6 feet tall, you need to be 150 pounds. If you're 106, you're 60, you're overweight. If you're 170, you're obese. And if you're 200, you're way obese." And I'm thinking, 6 feet tall, 150 pounds. How do you do that?
I told you I was getting life insurance. This was before I had cancer, a few years ago.
Yeah.
And I go to the gym every week for 40 years or whatever. And they said, "Well, you're in the obese category." I'm like, "What?" What? I go, I'm not obese. I go, you weigh 200 pounds and you're 5'10". And I go, "How much am I supposed to weigh?" 130 to 160.
Yeah,
I was
right?
like, "What? I weighed that much at junior high."
I was talking to my mom on the way to work the other day, and for 6'2", I'm supposed to be 190 pounds. I said, "Mom, I was 190 pounds, 31-inch waist, but that was like when I was 17. I'm not getting back to that."
I'm not saying I couldn't lose a few lbs right now. Maybe 2, 3.
2 or 3, yeah, at the most.
My wife says more, but she can't see very well.
Speaking of your wife.
That's right.
You get anything picked out for Valentine's Day? Are you ready?
I'm not going to say it here if I did.
Yeah?
But I did. Here's one.
So she listens to the show.
One thing for all you fellas out there. I was the idiot husband that actually listened to his wife one year, said, "I don't want anything.
Do not give me flowers. Don't waste your money." Oh, yeah, you get that.
Do not give me anything.
Do not waste your money on flowers.
That's a lie. I'm telling you, it's a trap.
That's right. It's a test.
That's right.
It's not a trap. It's a test.
I came home with nothing.
They're testing you.
"Really?" And I go, "You said you didn't want anything." "Really?" You didn't. Or I've done that mistake. I've done the mistake giving cash. Oh my gosh, that's so insensitive. I go, "But every time I buy something, you return it."
How about a vacuum or something they can use? That's always a nice gift. No.
Oh, you gave me a card, didn't write a whole love poem on it. I'm like, I'm not the love poem kind of guy.
Oh, dude, you got to buy 2 cards, and then you open up the one you're going to give her, and then you copy the words from the other one, and it sounds like you're William Tell.
Ooh, I've never thought about that. You're sneaky.
Well, plagiarism is not beneath me. But on the lighter side, Sherry's Berries. I've got nothing invested, no interest in them. Big, plump, juicy chocolate dip strawberries.
Sarah, call them if they want to sponsor the show.
What's
if
that?
they want to sponsor the show.
Yeah.
We'll get them there.
Maybe if we want a lot of calls, we should offer Sherry's Berries delivered on Thursday.
I can't do the sweets thing. If it was bacon, that'd be a different story. You got some bacon to go? You get me? I love bacon. Superfood. All right. Today's show, we're going to talk about a few things. There's something called like the sandwich generation. Sandwich generation, I'm part of the sandwich generation.
That'll be all of us.
It's people where you're still, here's the thing. As we've aged, people are having children later and later in life. Sometimes they're taking care of grandchildren even. But having their children at 40 when it used to be they had all the kids by 30, And so they've got that. But also people are living longer, so they're taking care of their parents and their children.
That's right. Double.
That's right. That's called the sandwich generation. There's a whole bunch of stuff like that. We'll talk about also some strategies, some tax strategies to look at. One thing that was interesting in the news that, everybody realizes that the United States is now the largest producer of oil in the world.
Yep.
It
Not the largest in reserves, but the largest in production.
Because we use a ton of it, right?
That's right.
Saudi Arabia was always number one. Russia was number two. Within 5 years, it is projected we will be more than both of them combined.
Who's largest in reserves? You think Saudi?
Probably Saudi, right?
But
Venezuela's got a lot too.
They're powering through a lot of theirs, though.
Oh yeah. So remember, there's cost like a tenth to produce.
Lifting cost is the term.
But the fracking thing changed everything. That's why my son was telling me, well, America's different now and blah blah blah. I was like, what are you talking about? I go, who invented this fracking thing? Who invented almost everything? He goes, well, who got the computer? How about the internet? As Al Gore, right?
It was Al Gore. That's right. Who was the Osama bin Laden deal?
Oh, I don't know.
I think that was Al Gore too. Anyway, I'm sorry. Go ahead. I digress.
Forgot he did that, but
yeah.
But yeah, I go. United States has invented pretty much everything. We take the best from all over the world. A German scientist relocates here.
Relocates is a nice way to say is we stole them after World War II, I believe, didn't we? We go
Some
over there
of them, not all.
Well, okay.
Some of them just came willingly.
All right. We educate the world here. Think about it. Where do people go when they want to go to a good college and get a great education? Most of them come here.
Yeah. There's a lot of it's hard being ex-military, not being really patriotic. When people start bashing, we're a bad country, we treat people. I'm like, we're the greatest country in the world. What's wrong with you? I said, why do you think people clamor to get in here? Like all these people talking socialism, I'm like, wait a minute. Don't they build walls to keep people in when you're social?
No. Everyone builds a wall. Just different reasons.
Yeah, it's so good, we got to lock you in here.
But
don't let people escape.
You're talking about becoming the largest producer. A lot of that has to do with the price of oil. Now, I know in the mid-50s now, it's not as great as when it was $100, and thank you, because we don't pay more for gas. But when the lifting costs are at a certain rate, you can afford to do the shale, right? You can afford to do secondary recovery where you do water injections, the fracking that you're talking about. All of that has added to, our production.
You remember when gas was worth nothing, they capped all those wells.
That's right.
And when the gas came up, they started reopening those wells because the gas was just burn it off. Let's get rid of the gas so we can get to the oil. Then gas started to be worth something. And then they said, wait a minute. We could do this horizontal drilling, this fracking thing, and get oil out of those same areas and get a lot more of it because we can go vertical or whatever. I mean, horizontal. I was like, huh. But, it causes earthquakes. Well, they said it didn't cause earthquakes, but all of a sudden there's a bunch of earthquakes in Dallas.
Is there proof for global warming?
Somebody goes, well, they've never fracked before. I've never heard of an earthquake in Texas.
No,
now there's 200 earthquakes a year in Texas.
Not related.
Yeah, that doesn't make sense to me, but all right.
It's funny. There's always someone out there trying to take advantage of the system. The Hunts back in the day, remember the silver deal, right?
Oh, yeah. At the corner of the silver market.
Tried the corner of the silver market. T. Boone Pickens, great Texan that he is, really was all over the gas thing when oil was getting up, remember, to $100, $125 a barrel. And I don't know how extensively he got involved, but he bought up a lot of that and was a real proponent and on the board and the whole deal for natural gas. I'm assuming since the price kind of leveled out and went down that didn't work out as well as he might have hoped yet. But someone else trying to corner the market,
I remember when they were all of your electric bill was based on natural gas prices as it was going up. Then it started going down, and it's not based on natural gas prices anymore. What do you mean? It's gone down for like 10 years in a row, and my electric bill hasn't gone down. It just keeps going up.
They try to lock you into a rate.
Oh, well, I've got a co-op. I live in Prosper. And I think it was a small town at first,
Right.
but I think they're going to have to let you be able to move to other.
Do you know what you're paying per kilowatt or whatever?
I don't think it's good. Unless, I'm paying like $500 a month for electricity.
Oh.
So I don't. Is that my high?
Nah, I'm about 4, so I
Oh,
guess
really?
it's your house is bigger, so.
But there's 5 people there too.
That's right. You're using a lot more stuff.
Oh, that washing machine and that thing is on.
All the time, all day.
24/7. And I've got kids over my house every day, every weekend. At least 3 other kids spends the night at the house.
Yeah.
So my house, I always wanted to make the house that everybody went to, so I can keep an eye on my kids. I don't know what they're doing somewhere else. Let's have them all here.
Yeah.
But I'm telling you, you know how much it costs me for pizza and chicken wings every weekend? It's a lot of money.
It's nice to
Well,
have
stay with us, folks. We're going to talk after the break about, is your IRA a time bomb, a tax time bomb? If you have any financial questions, you need to talk to us at all, call us at 972-715-2424 or go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you have any financial questions you'd like to take advantage of any of our no-cost, no-obligation services, like we do written retirement plans, Social Security Optimizer, you've got your family love letter that tells your loved ones what to do if something happens to you. It's in between a will. A will divides assets. This is in between. Call us at 972-715-2424. Again, 972-715-2424. All right, let's talk about, is your IRA a ticking tax time bomb?
Boy, I've heard that a lot lately.
One of my pet peeves, Guy and I talked about this a lot over the last 30 years. One of my pet peeves is when people try to get scared out of 401ks and IRAs to do something they're selling. Not much makes me more angry than people that do that.
Now, I will add, not to get you off course, they don't tell you this when you're starting out your 401k and you only have $5,000 or $10,000
No,
a
once
month.
it gets big.
This is once you've got, $300,000, $400,000, $500,000, $1 million saved. Now it doesn't make sense anymore for it to be in the IRA because we've got a better idea. It's a ticking time bomb.
That's right. And I was this happened as much as this week.
Yep.
Twice. And what they said, I looked at a plan. A client brought me this plan from this other advisor that said, okay, you're investing too much in your 401k. Number
An advisor said that.
Yes.
Got it.
Too much in the 401k. And this advisor had been doing this 20 years or
Fiduciary,
19 years.
do you know?
Yeah.
All right.
Yeah. And, it's funny. When I was younger, I thought somebody's done something 10 years is a long time. Now that I've done this 30-something, I'm like, whew, a junior.
And you look back at 10 years and go, oh, I've learned a lot since then.
You still want to talk to them junior brokers with only 20 years experience? All right.
We've got some junior brokers
Yeah.
here if you want one. I'll send you down the hall.
That's right. 20 years is not enough when you've done 30, right?
That's right.
But, yeah, they said too much in 401k. And I'm like, okay, here's my first red flag. Now, I do not like bashing other brokers.
Right.
Usually that's not something we do, unless it's blatant misinformation. Okay? Also,
Just tell them we have a different philosophy.
That's right. Also, they told them there's your IRA, they had $1 million in IRA. That's a tax time bomb. When you retire, those taxes are going to eat you alive. You need to move it all to a Roth IRA. All of it. And I was like, okay. Now, if you know math, that's the dumbest advice you could get for a normal person.
For a normal person.
Some people, it's good advice. Who's the person should take all their IRAs and turn them into Roth IRAs? Somebody that's in the highest tax bracket now and going to continue to be in retirement. All right, because that way you're protecting yourself against future tax increases.
And you're paying the same tax.
That's right. It's not costing you any more.
Right.
But if you're like most people, let's say you make $250,000 a year.
Or even 125.
Whatever it is.
Yeah.
I asked him, I go, how much do you expect to make in retirement? Well, I've got $50,000 Social Security and maybe another 40-something thousand for my investments. Okay, so $90,000. I go, okay, don't do it. And they go, what do you mean? I go, if you think about the tax you're taking out, you're only going to be maybe the 10% tax bracket when you're retired. You're in the 30% tax bracket now.
Think about it. If you had $1 million at 4%, roughly where it starts, it'd be another $40,000 a year that you had to take out at 70.5, opposed to adding $1 million to your current income and filing taxes on that in April.
Right. It's just not. Remember, it goes to your income. $1 million is going to go to your income, so it's going to lock you into that 37% bracket for sure. But let's say you're only in the 10% bracket taken out. So you can take out those withdrawals. If it's $100,000 and you want to take out in a year, or $50,000, whatever, you pay $5,000 in taxes on it.
And what if some of these
$400,000?
And what if some of these nuts raise our taxes to 70 or 90% that I've been hearing about lately? Holy cow!
Socialist people. Oh yeah,
I know it.
Oh, but that's what I'm saying is, you'll never raise taxes like that on somebody who's making a considerably less. If you're maxing out income, that's a different thing. Remember, they'll define wealthy as whatever they want to define it.
That changes too.
So, but if you're most people that you don't have a giant pension, you're going to live off Social Security and whatever your investments produce, right? There's no way you're going to have as much income as you have now. So therefore, even if they do raise taxes, you're better off leaving it into a regular IRA. I find mathematically, 90% of the time, people are better off keeping an IRA instead of making it a Roth. Now, does that mean I don't like Roth? No, I like Roth.
There's some times where it's really good.
I don't mind investing in a Roth. And once you've locked up or gone over, as long as you don't make too much income, putting money in a Roth is after-tax money that grows tax-free. That's a good idea. But converting, the IRS did not give you a gift when they created a Roth IRA.
That's right.
I saw an article on Investment News, the Roth gift. I'm like, wait a minute. If you have $1 million IRA, remember the government starts making you spend it at 70.5, called required minimum distributions?
Yes, sir.
It's going to take them 30 years, 40 years to get all that money out of their tax money. They figured out a way to get it in 1 year. And remember, they don't keep it, but they could make interest on it. So they got all that tax money. It took them 30, 40 years at a higher bracket, by the way, because you're using a lower bracket when you're retired. They said, but this might double our tax money by giving them a tax-free option.
If it was a gift, it was a marketing gift to the people to market who want to market it.
Our Roth IRA is good for other things? Sure. If I contribute to one, if I can don't make too much money, I can. Also, you don't have to take RMDs out of them. Your heirs don't have to. Now, they have to take RMDs, but they don't have to pay taxes.
It's a different, a different schedule.
So, no, there's a lot of good things about a Roth. It's just converting large IRAs into Roth rarely makes sense. Now, if you've got some tax write-offs where you can start taking $50 a year out and not pay tax on it, hey, that's a good idea now. There's a good idea for that.
Yep.
But we'll talk about more about that after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Right before the break, we were talking about it's rare that converting a big IRA or a group of big IRAs or 401ks to a Roth is logically or mathematically sound. But there are reasons to do it. Right before the break, we're talking about, let's say you had some write-offs, farm losses, tax write-off somehow from a business, and you're a S corporation, whatever, and you could actually get $100,000 a year out of that IRA and not pay tax on it.
And you couldn't use a tax write-off anyway, right?
That's right. Now that is not a bad idea. But if you don't have that as just a normal person that always makes more working because they got a paycheck coming in than retired, it rarely makes sense.
I won't go through all the numbers since we're on radio, but I encourage you to run the numbers. If you're in the same, and it's a math thing, and we love math, and it's counterintuitive. You would not think it to be true, but it is. If you're in the same tax bracket when you're earning income as you are when you're retired, and you have a Roth IRA, or you have a regular standard IRA where you take taxes out, it is analogous. It works out to the same, whether you pay to the penny, whether you take taxes now and don't pay taxes later.
Right.
You net what you would have had you taken taxes out and then had.
Now, if you're a higher tax bracket, the Roth makes sense. So if you're protecting yourself, but you already got to be in the highest already.
That's right.
And it protects you. But if it's a lower tax bracket, which is 99% of humans, it's worse to have the Roth.
Especially now.
But don't get me wrong. I've had clients do it. It's a very sound. If you have some kind of write-offs, It doesn't matter what tax brackets are if you can get it out tax-free.
Victor, I've had clients that had no business. It cost them money, and I couldn't talk them out of it. You try to go through it, and you explain it, and they love the 2 words of tax-free, kind of like muni bonds. It's not appropriate for everybody, but people love tax-free. They don't want to give Uncle Sam that tax.
How can tax-free not be better than taxable?
It's just better. Yep.
Yeah. Well, if your after tax is higher than your tax-free, that's what you want. I just look at numbers.
That's right.
Remember, we only do math here. Only math. That's why the vast majority of our clients are engineers and things, because it's just logical math.
The number one reason, I'll say this every show, the number one reason to have an advisor help you is it takes out your emotion of the equation.
That's right. So think about that. Normally, you should not roll an IRA into a Roth. Okay, normally you should not. But there are circumstances where it would be advantageous to do so. Just be very careful and run the numbers. If you've got a situation you think or somebody told you it was, call us. We'll show you. We'll give you a second opinion with the math, not what I think or just trying to scare you. Whenever they say tax time bomb, ticking time bomb, that's trying to scare you to do something else. Whenever they tell you not to invest in a 401k, they're not looking out for you, because that's the dumbest thing I've ever heard. You know, it doesn't matter. Your company only matches 3 and you put in 9. Doesn't matter. It's guaranteed money. It's tax deductible and tax deferred, and you do dollar cost averaging because you're buying new stocks every month. Anybody tells you that, or it tells you stocks are no good, they're the worst, or annuities are no good, or life insurance is no good. Every one of those is a tool.
That's right.
And you need that tool for certain things. Like stocks are the best to beat inflation long-term tool.
Hedge against
right? Nothing
inflation.
wrong with that. Annuities are the best income-producing tool.
For now.
Right? And your life insurance is the best after-tax tool, like maybe estate planning, things like that.
And if you're young enough and healthy enough, and you have substantial money, which is usually the trick, being young and having the money, you can really make some deposits into that to get tax-free income later. But you have to be young, healthy, and have a fair amount of money.
We developed this show 20-something years ago, and I always said we would have talked plain. I see so many advisors giving you the Greek alphabet. Oh my gosh, look at this alpha on this fund. Look at the beta. Oh, the gamma. The standard deviation. Ooh, it's off the charts. Most people don't know it. You're just trying to make yourself sound so smart that the customer will think, well, they know what they're talking about. They really don't. They're just reciting some number that also
and I hate to see their eyes glaze over. That's not making sense.
No.
So
we said we're not going to do that on this show this entire time. I've been asked twice this week, so I was going to address it. They said, what do you think about Edward Jones? I go, those places, they're everywhere, but they're kind of in small places. They're usually like independent franchise. I go, there's nothing wrong with Edward Jones. They're fine. They just seem to be held to 90% of what they do is American funds, which a couple American funds I like. Euro Pacific Growth is the largest international fund in the world. I kind of like it. Yep. Now, putting all my money in American funds, I don't know. But I think if you got smaller accounts, it's not too much. I wouldn't put millions of dollars in one fund family. It's not going to happen for me.
And you're only going to get what Edward Jones has approved from an Edward Jones broker.
They're not bad. There's nothing wrong with them. There's nothing wrong with a corner office Merrill Lynch guy. There's nothing wrong with them. When they start bashing other people, they're just trying to sell you something else. Nothing wrong with any of these. I want experience. I don't care what firm they work for. They got to have the credentials. They got to be a legal fiduciary. And they got to have enough experience.
That's right.
And now that we have over 30 years each, I'd say 30 years would be your minimum.
It wouldn't take anything less than 30 minutes.
29 years, not good enough. It's got to be at least 30. That's your ideal advisor.
Give them the number to call to get 30 minutes, to get 30 years worth of experience, Victor.
972-715-2424. Again, 972-715-2424. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. Remember, we do provide a welcome kit that gives you a little bit about us. We've been doing this for 30-something years each. Our company's been doing it since 1982.
Some good white paper in there.
Yeah, got some white papers. I think to put some bios in there. Just a company brochure. If you want to check us out, give us a call. We'd be more than happy to send it to you. 972-715-2424. Again, 715-2424. You can always go to our website, ilovemyretirement.com.
And I promise you there won't be a bad word about us in that package.
I got another good, this is the second time in 3 weeks I got another great compliment the other day. And they said, thank you for everything you do. I go, well, thank you. And they said, I've been retired for years, and the one thing I've never worried about is money.
Yeah.
And that's what our motto is. Our job is to make your retirement. Last thing you worry about is money. You can spend your time and research on stuff that really matters, your family.
I just got a portfolio that I was getting ready to review, about $1.3 million, and been working with the clients for, probably 15 years plus. The lady's dear, lost her husband probably 10 years ago, and I was going through the rates of return. And one thing that, Victor and I always tell everyone, on our guaranteed stuff, not the Fidelity managed money things, but on the fixed guaranteed income stuff, we tell them we try to shoot for between 4 to 6.5%, no down years, that sort of thing. And I was going through the rates of return over long term, 15 years. One account did 5.51% averaged for 15 years. The next account was 7.64%. And the next one was like 7.84%. This is over 15 years in something that had no risk.
4.46 the last 19 years and went down to half twice.
That's right. And so the first thing I did when I read that is I wanted to give her a call and let her know the great news, how well she's done over the last 15 years. And she wasn't home. I was so excited to tell her. And she wasn't home.
We also have, remember we talked a little bit about the RMD solution. RMD is required minimum distribution. Sometimes you'll see it minimum required distribution.
Yeah, they do.
But that's the IRS. When you turn 70 and a half, you have till April 1st of the following year to start taking money out of your 401k. The reason the government makes you do that is because they've never got $1 in tax money on this thing, and it could have been 50 years old, right? So in order to get their tax money, they're going to make you take it out when you're 70 and increase that amount every year till you die. Well, we showed you another thing that said, let's say you don't really need the funds, but you want to spend the RMDs. Let's say you got $1 million IRA. I'm 70 years old or I'm 65, whatever. I just know I don't need it. I got a pension. I got everything covered. Well, what if you could keep all the withdrawals and your heirs got them all back? Worst case. If it makes money, you get more.
You had $1 million, they get $1 million, but you've had your RMDs for 20 years.
And think about it. If you got 15 years of a normal $1 million IRA, you're going to take out $700,000 out of it, right?
$40,000 plus a year.
Yeah. So you're taking out $600,000. You put in $1 million, and your heirs get back the $1 million, and it's guaranteed until you're 85. It doesn't start going below $1 million to 85. Well, that's not bad because that's the normal life expectancy is around early 80s, right? So that's covered. And so if a person doesn't need wants the income, but the RMDs are plenty, but I want to give as much to my kids as possible from an IRA, that's a really good solution because it guarantees to like 85. It depends if you can do it a couple years before 70, you might get it to 87, 88. But that's not a bad deal. Your contractual worst case is theirs getting back full thing, and you spend all the RMDs.
You get your
for all
RMDs.
Those years.
That's right.
There's another strategy that people might look at. Let's say you don't need the income. That was when you needed the income. You wanted the income, but you wanted to give the full amount to heirs. Well, there's another one. Let's say you don't need the income at all, but you know if your heirs get this $1 million deal, they're going to get 60% of it because 37% is going to be taxed. Because 99% of every inheritance on this planet is spent within 18 months.
Yes, it is.
Even though you think your kid's going to last forever, 18 months is the normal for 99%.
That's like 99% of everyone that takes a second on their house to pay off their credit cards has what in a year? More credit card debt and now a second on their house. It just doesn't work.
So instead of leaving them this $1 million, which would be really 600 and some thousand,
right?
Okay, why not leave them the full $1 million? And you can give charity another $1 million, guaranteed. That's if you use an RMDs. You can use the RMDs to fund another thing.
That's correct.
That's going to give both, and you get favorable tax treatment because remember, IRAs left to charities don't have to pay the taxes, right? And so you have to pay still on your RMDs, but they don't have to pay on that lump sum. So you give a lot more to charity. You give the same to your kids if you don't need the income. And so those are a couple strategies, If you want to call, this is a person that I don't need to make a huge income stream. The RMDs, all I'm going to take out of these IRAs, or one IRA. Let's say it's one IRA out of 3. All I'm ever going to do with that one's that. So would you like to keep the income? Keep the amount together, guaranteed to 85, 87. All right? Or if you don't need the income, how'd you like to give, in this example, $2 million? $1 million goes to yours, and another $1 million goes to your favorite charity. We can show you strategies like that.
There's also some neat things you can do. 529s, we all know, for kids' colleges. Kids' colleges are very expensive nowadays and only getting worse. There's some neat strategies we can show you as well on how to fund those where you can still benefit once the kids' college is paid as well.
972-979. Oh, almost gave my number. 972-715-2424. 972.
Oh, give me your home number.
715-2424. So I got a question for the audience.
Yeah.
I know I think it's called the Hazelwood Act or whatever. I'm a veteran.
First college funds.
I didn't know that after my first went to 9 years of college. Right?
Right.
But I know now. I know that one works. There's another one. I adopted my third son through CPS. And I was told that you get free college tuition if you adopt through CPS. I want somebody to call me if that's true. I haven't been able to find it.
You've been trying to find it?
Yes, because I got 3 more going to college. And if they go 9 or 10 years, I'm going to be working until I'm 90.
I'm telling you.
We got a break coming up, folks. Don't hesitate to call us, 972-715-2424. We'll be right back after the break. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by 2 of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show.
We've been talking about RMDs. We've been talking about oil production, a lot of good things. Valentine's Day is coming up. We talked about the IRA tax ticking time bomb, which you have to kind of be careful. We love IRAs. We always encourage everyone to put as much as you can. You're saving taxes immediately, and it helps supplement your income in retirement. Speaking of concerns, some of the top 6 things that Victor and I hear a lot, some of the things that we work closely with our clients and our listeners in trying to prepare for retirement. Thought we'd go through those. First thing we've talked about a little bit, potential of increase in taxes. You never know what the government's going to do. We joked about it. But you never know which party's going to be elected, and we've heard some silly numbers lately, 70% in taxes, 90%, wealth confiscation if you have too much money.
Evil socialist, evil.
How do you plan for that when you're in retirement? Because you don't know exactly what the number's going to be, right?
Right.
So you got to keep that in mind. So what does that mean? If you can do something that's tax sensitive and maybe tax deferred, we talked about tax free is not always the best way to go.
Even though it's good, if you get tax-free, yeah.
Great words, but if you're paying more for that tax-free, it's not so good. What else? Look at what interest rates have done right now. Look what the Fed, in just a few increases they've had in 18, what it did to the stock market last fall. So interest rate concern, or otherwise known as interest rate risk. Mm-hmm. You know, as rates go up, your bonds
go down.
Value go down. Bonds used to be great, guaranteed for the government bonds, not all corporate bonds. By the way, I was going to tell you, I got a account from a client with Baptist Church bonds paying 8%. I'm just wondering how safe that is. It's kind of
pretty safe.
8%?
Yeah.
You load up on those.
Higher, but church bonds generally are decent.
Yeah, absolutely.
Right.
But the rate was a little bit of a concern. So, but interest rate risk, you don't know where it's going to be, and who does it affect the most? Retirees, right? Because you want to be safe and you want to get a good interest rate. If you could get a CD or something simple, and you can get 5 or 6%, you're happy. So you've got to plan for that. Market risk would be number 3. We talk about the rule of 100. Basically, your age is what you should have safe. Why? Because you want to avoid market risk. You want to de-risk your portfolio.
That makes sense. When you're 80 years old, you should be 80% risk or safe. Probably safe, right?
Probably safe.
When you're 20 years old, should you be 80% safe or at risk? Probably at risk.
Probably at risk.
But that also is not individuals. Like, I was a pretty conservative 40-year-old, right? And I'm a really conservative 55-year-old.
Absolutely.
So it depends, you know. I'm a risk taker to some degree. I own stocks. I've owned them for decades. But I like the safe stuff too. And as I get older, I like more and more of the safe stuff.
They've been up. And so we help people de-risk their portfolios as well. It's important. Inflation, which is why you should have some money in the market. The average inflation over the last 40 years has been 3.4%. Now, Victor and I, when we do our retirement analyzer, we use a smaller number. We try to be a little more conservative, 2.5%. But think about it. For the last 40 years, it's averaged 3.4%. If you put that number to your budget and extend it over the next 20 years, you will be shocked what your budget grows to.
If you got 10 grand a month in bills, by the time you're, say, 75, 85, you might have 20 grand a month in bills. It goes like that.
That's a big
Some
deal
things
to
grow
do.
faster. The medical inflation is growing like 6 to 8% a year. So it's doubling every 10 years. So after 20 years, that's 400% increase
It's one of the fastest
in medical
growing areas.
costs.
That's right.
And that's stuff people didn't account for when they retired 20 years ago.
Number 5 is longevity risk. Obviously, we want to live long if we have quality of life. I don't want to live long if I don't have quality of life. But we're living longer.
Right.
So what does that mean? It takes more money, right?
Yep. I always tell them, if I have no idea what's going on, yank the plug.
That's right. Oh, yeah. If I'm with you, absolutely. And number 6, hardest thing when we try to sit down with somebody and budget is healthcare. We don't know what someone's going to need, what you're going to run into, but you've got to plan for it. So there's techniques and strategies that Victor and I use at McClure Capital all the time to address these concerns. If you have questions, if you just want to sit down and see what it might look like for yourself, give us a call.
Yeah, it's 972-715-2424. Again, 972-715-2424. Remember, I'm going to have to go into next week about the sandwich generation.
Yeah.
People like myself that take care of kids and parents. I have for a long time, actually.
Yeah, you have.
And so those are kind of things that are kind of unique. And remember, everybody will get their kids through college, or they want to get their kids through college. But the one thing you got to be careful of is not saving for your own retirement. It's not selfish to get a loan for retirement, because you can get a loan for college. You can get grants for college. You get scholarships for college. Is there a loan or a grant for your own retirement?
No one will loan you money for that.
Yeah, you can go to the bank. I didn't save any money because I was sending my 5 kids through college, but could you loan me $10 million? I'm retired. I don't have a paycheck anymore. But could you loan me $2 million so I can buy some retirement money? It ain't going to happen.
That's right.
So save first. Do that next. Don't get me wrong. Your kids will understand if you have to. Now, if you can do both, God bless you. That's okay. That's fantastic. But if you can't, you got to think about yourself first, because nobody's going to fund that retirement. Everybody goes, well, I'll just work till I'm 80 or whatever. What if you can't? I plan to work till I drop. But what if I physically cannot? And I'm telling you, they say age discrimination is against the law. Try to get a job at 73.
What do they tell you on the airline if the oxygen mask comes down? Put yours on first so you can help the kids.
That's right. Well, that's our show, folks. I want to thank everybody for listening today. If you have any financial questions or like to take advantage of any of our no-cost, no-obligation services, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.